Okay, good afternoon, everyone. Thank you for joining us in what is our last webinar of the year. Delighted to bring this topic to help you, give you some ideas in saving tax and some financial planning opportunities that you can consider heading into 2023. My name is Mitch Young, co-founded the Fusion Consulting Group, and joining me today we have Henry and Chris, who you'll hear from a bit later as part of our senior advisory team here at Fusion. We're going to be discussing tax and financial planning in particular, and we've brought with our best experts that we have in-house at Fusion. Fusion Consulting Group, what we've tried to build here is a new take on professional advisory, modern advisory, having all your key advisors under one roof, providing you tax, financial, accounting, legal advice, working in sync to get you the best save tax, save money, and obviously in a good financial position. As always with our webinars, we are offering a free consultation. So today we're offering a free 360 consultation whereby myself or Henry or Chris can join you on a call to discuss your tax and financial matters in greater detail. And hopefully we'll be able to assist you with that. As always with webinars, there is the chat function available. So if you did have any questions in relation to anything that we're discussing today, please feel free to put them in the chat bar. There's Q&A. For those that are watching live on our social media channels, if you do have anything specific that you'd like to ask about tax or financial planning, please feel free to put that in the comments, and I will attend to those towards the end in our Q&A session. So in terms of the agenda today, there is going to be a lot of information. Henry is going to kick off in a few minutes talking about some things you should consider from the tax side, some changes that came around in the November statement and what you should be considering in terms of tax planning. He'll then pass you over to Chris, who will give you some information around financial planning, investments, and things to consider. And then I'll finish off to talk about tax planning, some of the things that we've been working on in practice to help our clients be more tax efficient heading into 2023. And then we're finished with a Q&A session where we'll all join the screen again and go through any specific questions that you may have. This webinar is being recorded and it is being streamed live on social media. So if you did need to rewatch it, that will be sent to anyone who's registered tomorrow, and you'll be able to access recordings via our website. We're expecting the webinar to last around 45 minutes, so hopefully you're sitting comfortably, and I'm now going to pass you over to my colleague Henry, who will take you through the first part of today's webinar.
Thank you very much, Mitch. So my name is Henry. I'm a senior tax advisor here at Fusion. I'm a chartered tax advisor, and what I'm hoping to go through today with you guys is looking at a lot of the changes that took place in November. So as we know, it's been a bit of a crazy couple of years with the pandemic on one hand and having this inflation on the other. And I think what I've started to see and what I've noticed in broader terms is there's been a lot of tax hikes, in particular for middle to higher earners. And we'll go through a lot of those in the next few slides. But one thing I just want everyone to bear in mind is that a rising tide raises all boats. And whilst we're looking at the potential recession looming, a lot of tax changes are going to be coming up. So what we're going to look at today is how some of these tax changes could affect you, your income, your wealth, or your family's wealth, and hopefully give an indication, a little taster into what it is we offer here at Fusion. So the first one I want to start with, capital gains tax. So this one has been given quite a lot of revisions, particularly starting from next year. So the capital gains tax annual allowance is being reduced to £6,000 from the 6th of April 2023. This is going to be reduced again on the 6th of April 2024 to £3,000. So the capital gains annual allowance was originally given for people to essentially stay out of the tax system. So if you had some stock in, say, Amazon or Apple, you sold it, you wouldn't have to file a tax return or pay any tax on that gain, provided it was below this capital gains annual exemption. So this reduction is effectively a tax increase for some of the more maybe seasoned investors who are looking at, more than £12,000 a year in capital gains for a year. So the effective increase will mean that we at Fusion are going to see a lot more people who are going to be filing tax returns to report some capital gains. So if you exceed this threshold in the future, you will have to start paying capital gains tax on that amount. What's interesting is that the capital gains reporting threshold is frozen at £50,000. So even if you sold £50,010 worth of stock and you received no gain, or if you're in a loss position, you would still have to report that capital gain on the basis that if the proceeds, so the value of which you sell, is in excess of this £50,000 per year. So with inflation, of course, values will increase for tax purposes, but then in real terms, they might not necessarily increase. So this reporting threshold is essentially a tax hike for those people who are looking to draw down on and utilize these annual exemptions each year to ensure that they're efficiently drawing down on their investment. So a lot of what we see is that a lot of clients try to sell off a certain amount of stock each year just to ensure that they are their capital gains tax is kept below this threshold so that they're efficient. So it's a use it or lose it. So if you don't use this each year, then you will lose it next year. So going into 23-24, a few of the planning opportunities we will touch on is keeping the proceeds below £50,000 a year. So unless you are already in self-assessment, I would always advise caution when selling to make sure that you're not falling into the tax regime and having to pay. And even if there's no tax due, having to file a self-assessment tax return just to report that there's no tax due. Looking at keeping chargeable gains below the 6,000, 3,000 threshold. So if you are someone who sells, maybe a passive investor, someone who has a bit of crypto on the side, you're looking to keep those gains below the threshold each year. So if you're selling down each year to realize some gains and reinvest your portfolio, then keeping it below these thresholds, and notice that they are decreasing. So of course, naturally, this exemption might be further reduced in the future if going by historic trends. When looking at gifting property, of course, we need to consider what the market value of those properties are, because if you're, say, trying to gift a property to your close family members, the market value of that property will be used as a deemed disposal. So we need to consider if gifting these properties is going to be subject to capital gains tax when you bought it to the market value in which the date from which you gift it. Gifting between spouses incurs no CGT, so a husband can give to a wife and there'll be no capital gains consideration. And lastly, just stamp duty. So stamp duty is always a bit of a tricky one, especially for people who aren't too familiar with how tax and the interaction between stamp duty and capital gains tax works. But stamp duty is essentially based on consideration, not deemed market value. So if there's a mortgage on the property that you are gifting, we would have to consider what that mortgage is to assess what there is in terms of stamp duty on that transfer of that property. So gifting is a very good way of inheritance tax planning. So if you gift out of an estate, so if a client was looking to reduce their exposure to inheritance tax, one of the ways in which they do it is by reducing the amount that is effectively in their name, in their death estate. So one of the effective ways of reducing one's value of estate is by giving money to children, to grandchildren, friends, other family members. So gifting is very effective. However, there is unfortunately a caveat, which is if you only need to pay inheritance tax on a gift that you make if you die within 7 years of making that gift. So of course, no one can see into the future, and what this gift essentially says is that you can gift as much as you want, but if you do unfortunately pass away within 7 years, we will have to, it's called a clawback, and you will have to look at what was gifted and look at potentially including those within that inheritance tax calculation. So of course, some people might think, well, if I give all my money away, I have no exposure to tax. But unfortunately, that's just not necessarily the case. You do have to survive more than 7 years. So making sure that you are very clear on your potential inheritance tax obligations as a result of any sizable gifts, particularly in relation to property or passing down family assets. So trusts is a fantastic measure. Trust can be a very controlling way of looking after family assets, particularly if you are, say, you want to give assets to your children, but maybe your children are minors, or maybe you want to retain an element of control with that. You can effectively set up a trust whereby you have ultimate say on how these assets are spent, how they're used, and effectively manage the sort of day-to-day administration of owning those assets for the benefit of someone else. So one of the advantages from an inheritance tax point of view is the trust assets are outside of your estate. So whilst we just explored that 7-year rule, you do need to consider when an individual dies, their trusts that they've settled remain outside that death estate. So they do not incur any inheritance tax when an individual passes away. Of course, the 7-year rule we mentioned earlier still applies. So if you settle everything into a trust and it is above the IHT the exemption of £325,000, then we can look at a potential inheritance tax exposure there. So some gifts you make in your lifetime are also subject to something called lifetime tax. So this is effectively an inheritance tax charge you pay upfront for settling assets into things such as discretionary trusts. And what it does is it's effectively saying that whilst this is outside your death estate, you are liable to paying some tax if it is above this £325,000 exemption mentioned earlier. So trusts are very good, and that's not to get me wrong. However, there is a lot of tax peculiarities that need to be considered when thinking about using a trust. So one of the things I've noticed is a lot of people come to me and ask, I can set up a trust. It's exempt from inheritance tax. I don't have any. I will be able to settle myself as the beneficiary. I'll be able to set up a web of trusts and manage all my assets that way. But unfortunately, that sort of tax plan doesn't usually work in the way it is intended. And my advice is always to seek expert tax advice before looking to set up any sort of trust assets or trying to set up any sort of structure in which you're looking to potentially reduce your liability to inheritance tax. Because the best piece of advice I can always give is to seek advice before, because once these assets are settled in the trust, unfortunately, there could be complications which we would have to deal with, and it can just rack up more fees and just ultimately not achieve its effective goals that you looked to set out. So when you make a gift, say if I give cash to my grandchild, this is called a potentially exempt transfer. So it's called a PET for short, PET. It is a gift that someone has made. There is no there's no tax payable when you make the gift. There's no inheritance tax payable immediately on that gift. And it is effectively, it's potentially exempt because you haven't lived for 7 years yet. So it's saying that in 7 years' time, this may be a future charge to inheritance tax, and it may form a part of your estate, but we don't know yet. So they just call it a PET for short. So PETs are completely exempt from inheritance tax if you survive more than 7 years. You can give away £3,000 each tax year without that gift being considered a PET. So if you give away in total across all of your gifting a total value of less than £3,000 each tax year, then for inheritance tax purposes, that's disregarded. You don't need to think about that in terms of looking at these potentially exempt transfers. Because one of the issues with this kind of gifting is that you don't know if you're going to survive. So oftentimes when a gift took place that happened maybe 6 years ago, it's up to the executors of the estate to figure out what gifts took place and look at a sort of timeline of what it was that was gifted, how much, and to which beneficiary, because oftentimes no one keeps a list of what it is they're gifting to individuals, especially if you're, perhaps maybe if you're elderly, you won't have a perfect record of what it is you're giving away in terms of money out of your estate. So one of the jobs for the executors is to accumulate all of this information and try and look at the entire 7-year period and assess if there had been any of these taxable gifts. So when a pet becomes liable to inheritance tax, it's called a failed pet, and that's hence why there's a £3,000 exemption. Because of course, I think if there had to be a certain point at which it was worthwhile for an individual or HMRC to actually investigate this further. So although it doesn't tend to increase every year, HMRC have put a de minimis on what is worth their time in terms of clawback on inheritance tax. So I mentioned earlier, gifting discretionary trusts incur these lifetime charges. That's only if the gift is in excess of the nil rate band, which for many years, for over 10 years, it's been £325,000. These chargeable lifetime gifts are also potentially, so with the potentially exempt transfers, there's no immediate tax charge. With the chargeable lifetime transfers, there are immediate inheritance tax considerations, but both of them, if you died, would be subject to inheritance tax on your death estate. So chargeable lifetime transfers are immediately subject to a 20% tax, but a 40%, as most people know, inheritance tax in the UK is currently 40%. So that 20% difference has to be paid has to be settled upon death of the transferor. So either the trustee or a transferor can pay the inheritance tax due on these lifetime transfers. However, that's up to the consideration of the settlor. So the transferor, they want the trustees to spend the money that they ultimately settled into trust on a tax liability. So oftentimes it makes more sense if you say want to buy a £500,000 property. If you put £500,000 into a trust, you would have to pay £100,000 of tax within the trust. So ultimately the money is going to reduce, and you would only have £400,000 to buy a property. So of course, naturally, to get around that, you would want to make sure more money is being put into the trust. You are incurring a larger inheritance tax liability up front. However, you're ensuring that there's a net amount left over in the trust to use for your discretion. So moving away from inheritance tax and the topic of death, dividend allowance was something that has been significantly changed. So before, the dividend allowance used to be £2,000. From 6th of April 2023, dividend allowance is being reduced to £1,000 per year. And again, from 6th of April 2024, the dividend allowance is being reduced again to £500 per year. So a lot of individuals, particularly small business owners who have paid themselves a small dividend each year so that they didn't have to pay any tax on it, will either spouses, if they have shareholders who are also receiving these dividends, would need to consider potentially reducing those dividends in line with these revised thresholds. What's interesting is that the dividend allowance has been fiddled with for the past few years. Of course, I can foresee a situation in the future where it is eventually reduced to zero. Of course, I think for a lot of small business owners, it was always been a sort of a nice enough little buffer before paying tax, but ultimately you're not gonna, you're gonna pay yourself the dividend that you want to pay, and then the tax exposure follows it. So I think the Treasury is eyeing up this relief and seeing it as maybe too generous for small business owners and looking to taper it down. So of course, I mentioned earlier, we've had to consider that higher earners are some of the individuals who are going to be most targeted by these tax hikes. So when in previous years, usually the additional rate band had always been the point at which it was seldom ever. I mean, a bit of history on it, when the additional rate band was first introduced, it was only for the highest of earners in the UK. Of course, with inflation, this rate has rarely ever been increased. The additional rate band in the UK has rarely ever been increased, and in fact now it is looking increasingly lower, and it's been it's just a matter of time before this rate will be further decreased to say £100,000. And of course, at what point do we start saying that this is no longer considered higher earners? These are just middle income individuals who are paying this additional tax. So from 6th of April 2023, the additional rate band is being cut from £150,000 to £125,000 per tax year. So for an individual, use an example, for an individual earning £150,000 per year, that is an immediate income tax increase of £1,243 per year. Of course, it's additional inflationary tax increase on high earners. And my suggestion would be, and the suggestion we often give our clients, is trying to reduce your taxable income. So if you're, say, a salaried individual, looking at salary sacrifice pension contributions to reduce your taxable earnings, self-invested personal pension schemes or SIPs to extend this additional rate band so that you're paying less tax. But what's curious about this £125,000 figure for the additional rate band, it is individuals now are, when you earn over £100,000 per year, you start to lose your personal allowance. So this now synergizes, or it lines up better with that. So every year, your personal allowance is fully tapered when you earn over £125,000. So now this more or less means that you're going from a higher rate to an additional rate a lot quicker than in previous years. Last thing I'll touch on, employment taxes. So in the past, a lot of individuals were buying electric vehicles because of the tax preferential treatment of them. So company car benefits will be increased by 1% for electric car and ultra low emission vehicles. So what that means is a 1% increase is on the list price of the vehicle. So if you own a £50,000 car, you will start to see a 1% increase in the taxable benefit for that car. And an ultra low emission car is defined as a vehicle in which CO2 emissions are less than 75 grams per kilometer. And what's interesting is that this is obviously counter to the government's initiative to try and push for more electric vehicles and carbon neutrality by 2050. So at some point, this tax incentive for green cars had to be reviewed, and it seems as though this is the first year in which they're starting to eye up electric cars and trying to establish a more broader tax base for these people who were seen as getting too generous of a deal by the government. Great, so I will hand over now to my colleague, Chris, and Chris will just run you through some of the financial planning, and hopefully if you have any other questions as you go, please feel free to drop them in the chat box. But thank you very much, Chris.
Lovely, thank you, Henry. Appreciate it. Lovely. Hello, everyone. I am the independent financial advisor here and a senior member of the team. As an independent financial advisor, regulated by the Financial Conduct Authority, the FCA, fully independent, which means I can access the whole of the market, etc., etc., etc. Near enough. I'm the good guy. I'm the person you want to come to when you're talking about pensions, investments, life insurance, and a bit of a holistic financial review of your circumstances. I'm going to cover a few things today, obviously, with that April deadline coming up, April the 5th. You've got X amount of time to do things. There's only so much time that we need in order to do the analysis. So we can, near enough, if we chat in January, you're guaranteed to get a fantastic tax plan before that April deadline. Please reach out to us if anything is interesting, or at least you just want to have that chat. I can talk you through the whole shebang within 20 minutes. You'll come out of that meeting either knowing that you can save a bunch of tax or otherwise. So please feel free to reach out, my email, or in the comment section, please let me know. Great stuff from Henry. Obviously, talk about inheritance tax. Near enough, if you get in a room with me and Henry for an hour, we could probably save you as much inheritance tax as you like. You just tell us how much you want to pay. They call it a voluntary tax for a reason. There's amazing ways to get around it. As Henry has alluded to, the benefit of, obviously, of what he said is there's more than one way to skin a cat. We just got to find out what cat it is and go with the skinning. So please do, again, reach out if that's an area for you. Last minute calculations. So the main areas that we're looking at when we come to end of year tax planning are pension funding, the ISA allowance, capital gains planning, and obviously setting up for the next tax year. You might as well have a conversation now about next year, get it done, and then not have to worry about it and rush it through last minute like everyone does. We'll have a queue of people waiting for me in January to have these conversations. If we have that conversation April the 6th, when the new tax year starts, then you're ahead of the curve, you're ahead of everybody else. So the key areas, what can you do between now and April to get some benefits from the tax man? So pension contributions. If you are paying too much income tax, if you don't want to be paying that much income tax and you have money available, either in your business, if you're an entrepreneur or you have a business, either from spare salary, even if you're talking about, I think Henry alluded to salary sacrifice, talking about how you can use your auto-enrollment pension to get even more benefit, gain some employer NI contributions back. Massive conversation, very easy to do. So if you want to stop paying income tax, you make a pension contribution. It extends your band, which basically pulls you out of the higher rate of tax band, though especially, as was alluded to by Henry, if you're in that sort of 125,000 to 150,000 range, you're going to get it hit pretty bad at the moment. Even above 100,000, reach out. Definitely pension contributions are probably where you want to head. And that's going to save you, I think there's a statistic, it's something like 67% tax relief if you do it between that 100 and 125,000, 140 zone. So, it's a pretty amazing sum, really. That does need to be said. But worth having the conversation. There are things to be aware of. You'd be surprised at what is available to you. You can contribute in a lot of ways and a lot of theories. So just have that conversation. Corporation tax relief. If it's your business, you pay yourself a pension contribution. It's like you've paid yourself a salary, but you don't pay any tax on it. It's a cost of the business, so you save your 19% corporation tax, which of course we know is going up to 25% in the new tax year. So big saving already. You're not paying income tax to get it out of the business. You're not paying dividend tax to get it out of the business. It's your money. And then when you want to access it, you can in a tax efficient way if you talk to us, and we can do it properly for you. And it's inheritance tax free. Again, an amazing saving of 40%. So if you're thinking about saving tax and you've got a bit of money to do it, this is probably the zone you want to look at. Seek a professional. We can do it. It's easy to over contribute as well. A lot of people put in, £300,000 into a pension and then suddenly get this amazing massive tax bill because you've over contributed. There's a calculation. We do it. We tell you how much you can contribute to get the maximum pension relief. Please reach out. We can do that. Lovely. And of course, I've just had a baby myself, or not me, my partner. One of the best things you can do for tax efficiency is to start contributing to a pension for your children. They're still a person. You can contribute the minimum, even though they're not earning. I think there's a theory that if you contribute the minimum to your child's pension for 18 years or so, or 16, 18 years, they'll be a millionaire by the time they hit retirement without ever having to put a penny in themselves. So, crazy figures there, which is, not guaranteed, but a good reason to have a look. Fab. So most people know ISAs. You've probably not been offered one by your bank. Here's a cash ISA. It will pay you percent per annum. It probably makes sense. You'll just open one up. You can put £20,000 a year into ISAs. You can open a stocks and shares ISA and a cash ISA each tax year. Near enough. If it's your money, it's past your emergency cash band, and you want to invest it, your stocks and shares ISA is the place your money should really be. It's the only place you're going to beat inflation in what is a crazy time. So understanding that you can transfer your cash ISAs to a stocks and shares one. We advise on that. Understand that you can put your 20 grand in, open up a stocks and shares ISA, open up now, and then as soon as April 6th comes along, you can put another 20 grand in. So that's £40,000 you're invested towards your future in a tax efficient environment. Crazy again, just not quite as good as the pension, but still very, very good if you want to access that money. Let's have a look. Junior ISAs. So again, something that's incredibly important, which is you can put £9,000 a year into a junior ISA for your child. Again, if you have that money, if you're doing that until they're 16, that's their house deposit. In an environment where property prices are going absolutely crazy, this money could be invaluable. So I highly recommend having a conversation with that as well, especially if it's invested and increasing in value that way as well. One of the biggest things I get probably working at Fusion is a lot of property investors, and probably people say property does better than investments 9 out of 10 days of the week. And if you're probably comparing it to the pensions you're used to, which are the ones you've probably picked up from an employer somewhere, yeah, maybe, but that's not the case. When you see a financial advisor such as me, our goal is to beat the market, to be in the best stuff available, and very much easy to do. I say easy, it's not easy. I try and make it look easy. It's tough, but we're doing very, very well. Since May 21, Ukraine war, COVID, etc., our investments have been absolutely smashing the market, where everybody's been losing money. We made some changes, made some tweaks, and it was, all of our clients are doing very well off the back of it. We think it's going to continue in 2023. You might as well join us, be in it, and come along for the ride because we're doing amazingly, and we believe it's going to continue. So yeah, blue line there. You see the peak on that blue line. That's around about when we got out of the blue line stuff and got into something that's done it very well. So, this is easy stuff if you do it right and do it well. So this is what the experts are for. Capital gains tax planning. Henry covered quite a bit of this, but if you have capital gains tax, realizing some this year, or it's capital gains, just to use your 12,300, use it while you've got it. The £6,000 is coming in, the £3,000 after that. It's all getting worse. If you've got a bit of Bitcoin, you think might sell a bit, you can do that. Even if you want to buy it back, there's something called bed and breakfast. As long as you sell it and then wait a month and then buy it back, you're fine. So yeah, have a conversation with us about how much you can sell, why. We'll do the calculations, and it's a no-brainer really. I might try and convince you not to buy Bitcoin, but that's my prerogative. If you I always say to all of my clients who are in Bitcoin, as long as you're willing to lose it, go for it. Better nicer, it's exactly the same thing as bed and breakfast, but you take your investment, you sell it, you realize your £12,300, and then you put up to 20 grand into a nicer, so that it's in a tax efficient environment and you never have to do that activity again, which is obviously the whole purpose. It makes everything easier. More properties being sold. Got a few clients talking now about doing that. They're on variable rates, times are getting hard, unemployment rate going up. It's going to be a dodgy year next year. A lot of people selling properties, or like Henry was suggesting, giving them away in some sort of fashion if you can afford to do that. But certainly, if you are in that market where you're thinking, I want to sell my property because it's not a feasible investment anymore, what else can I do? I'm your guy. I can tell you exactly what you can do, and I think it's going to do very, very, very well, especially compared to property in the next year. So yes, setting up for the new year. Little things you can do. If you are a business owner, you can use your business to pay your life insurance. If you have life insurance at the moment and you're paying it personally and you have a business, then it makes a load of sense to have a look at it and see whether you can pay that premium through your business. Again, it's a cost to the business, less corporation tax. You're not having to pay tax to bring it out of the business first and then pay the premium. So some big tax savings there with a very small change. We can set that up for you if you want to have a look at it through us. Very happy to do that, no charge. So well worth doing. We do the admin too. April planning, again, I cannot mention this enough. If you're sitting there thinking, oh, maybe I should think about that, now is the time. We should have a conversation in January. If it leads to nothing, it means that's totally fine. It means there's probably not a way to help, but I guarantee you there's more than likely something I can do between January and April, and it is my busiest time. So please reach out today and let's get that in the diary. 20-minute chat. That's that easy. And yeah, planning for the next year. You could do a big lump sum this tax year. All the calculations you get, congratulations, fantastic. But if you're going to do exactly the same thing next tax year, you might as well set up a regular payment so you never have to think about it again. It's done. It happens automatically. X amount comes out of the business and goes into your pension. X amount comes out of your bank account and goes into your ISA. You never have to come and have a conversation with me, but I'll miss you. I would love to have that conversation with you. And I'm sure we will. We do annual reviews for all of our clients. Come around, have a coffee, have a chat. How is everything going? Talk about the tax year, etc., etc. But if I can get you doing all the right things before that chat, then it will just be a coffee. That's my goal. So please again. Lovely. So yeah, corporation tax. I'm going to hand over to Mitch now, I believe, to talk about this. So please, Mitch, take over. Cheers, guys. Take care.
Yeah, thanks, Chris, and hi, everyone. So we're just going to finish off with a couple of pointers for corporation tax and some of the things that we've also been helping our clients with from a tax planning perspective. So as we know, corporation tax will be increasing for businesses that have profits over 250K from 2023. And one thing that we do a lot of here at Fusion is many clients will be sitting on cash reserves. Sorry, let me just turn that. Many clients will be sitting on cash reserves within their business, and what we're finding historically, they take those monies out and they invest in property, stocks and shares, watches, other types of assets. But of course, when you take money out of your company, you pay income tax on the dividends as a distribution. So what we're looking at when it makes sense for the right clients on a commercial basis is they may have their trading business, they may have a property business, they may have another business. And what we can look at, instead of extracting the funds individually, we can look at it structuring or restructuring what limited companies they have in what's called a corporate group. And essentially what that is you have your holding company of which you and your the shareholders own, and that acquires the shares of the trading business of which you have individually. So the holding company becomes a shareholder of the trading business and then all the other entities along the way. So then what you can do is, if you've got large amounts of profits in the trading business, you pay, instead of paying a dividend downwards to you as a shareholder, you can pay a corporate dividend to the holding company. A corporate dividend into the holding company results in no additional tax. There's no tax on a corporate dividend. Then you can move that dividend into your property company to fund a deposit on a property without there being a tax implication, or indeed fund the stocks and shares portfolio, fund another business, fund something else, keeping it all within the corporate group. What's also interesting about what we call a corporate group is that if you have a loss-making company or a loss-making entity, that when you formalize a corporate group, you're able to offset that loss against profits in your other businesses and your other group. Now, in order to achieve that, there's a process that you need to go through with HMRC called statutory clearance. And essentially what that is a detailed letter looking at your business case, looking at the commerciality, quoting case law, because of course you can't, the main purpose of what you're doing cannot be just for tax avoidance, and there is anti-avoidance around this area. So you need to put a business case to HMRC, and we've got a very high success rate in establishing these. And you send that off to HMRC, and HMRC give you a rubber stamp saying they approve your clearance, and then you're able to create the structure, do the necessary shareholdings at Companies House, share for share exchange, stamp duty exemption forms, and then start operating in an efficient way. So if anyone's listening, watching, that has trading businesses, that have cash reserves, that are entrepreneurial, that want to reinvest, then consider, this period to look at your corporate structure and essentially maybe look at restructuring in an efficient way. The next part, what I want to talk about, what we do a lot of, certainly recently, is around intergenerational tax planning. So our typical client that comes to me may be, guy or girl in their sort of 40s. They've got assets, they've got income, they may have a business, they may have properties, children, and we're discussing their tax planning. But more often than not, they're saying, like, my parents own XXX, and we're going to inherit that one day. So we need to come up with a structure that's agile enough to look at their tax position for their immediate family, but then have one eye on what their parents are doing and how that inheritance is going to fit into their structure. So we're looking at family tax planning, intergenerational tax planning, with the parents at the top, structuring that, the sort of adult children in the middle, and then obviously the younger children, with a theme running through it of legacy planning, maybe some trust work, but equally having a strategic plan across the intergenerations. Because what you don't want to happen is that you pay someone for tax advice, be it us, whoever, and then further down the line, there's going to be other businesses coming into it, other properties coming into it, and the structure isn't set up in a way to facilitate that. So intergenerational tax planning is a thing, it's happening, we're able to deliver that, and it's something that for those who are going to inherit assets should think about as part of their tax planning over the new year. And this leads me on to the topic that we talk regularly about here, is a family investment vehicle. So this potentially could be your holding company, or it could be, just in your trading company, whereby you're bringing in your children, looking at different classes of shares in order to benefit from future growth sitting outside your inheritance tax and your estate, so that they can benefit from that. So there's good tax planning around there, particularly when your children get to adult, can benefit from their allowances as well. But one other thing that we're seeing a lot of in practice is employee ownership trusts. So if there are any business owners out there who are looking at employee schemes or ownerships, we are seeing the popularity of employee ownership trusts. And heading into 2023, we will be doing a specific webinar on that topic as well. So you've obviously heard from Henry and Chris talk about now is the time for tax planning. It's a great time, head December, over Christmas, January, invest in your tax planning. Let's look at the allowances. Let's look at the reliefs. Let's see what we can benefit from before April 2023, safeguarding those reliefs that are out there. There are still positive tax reliefs available, which are still they haven't been withdrawn by the government. And as we know, every budget there could be changes, but there still is the availability of principal private residence relief. There still is the availability of business asset disposal relief, business property relief, agricultural property relief. So there is a lot of relief available that by doing tax planning, you can safeguard your position today, because HMRC can't go back retrospectively and change the legislation. So I urge you all to contact your advisors to take the winter months to look at your planning ahead of the new financial year. So hopefully we can bring back Henry and Chris, and we're running a bit over today, so apologies about that, but we'll hang around for the next few minutes. If anyone has any questions, feel free to jot them in the chat bar. You've also can see on screen some nice pictures, but also the email addresses of all of us. So if you did have any personal questions that you wanted to discuss with any of us, our contact addresses are on the screen now. And of course, if you wanted to take advantage of a consultation with all of us and yourself to discuss your circumstances and see if we can help you at Fusion, please feel free to contact me and we can arrange that. So we'll just come on to some questions. So I think one for Henry, one for Chris to begin with. It's good that Henry's here because I can just pass all the questions on to him. So that's good. So we've got a question from Amy who says, hi, are there any inheritance tax if gifting properties between spouses?
Yeah, so there's a short answer and there's a slightly longer answer. So I'll start with the short answer. Yes. So in most cases, gifts between spouses are exempt from inheritance tax. So I think kind of reading in between the lines, gifting property between spouses. So if you own a property that's jointly held with your spouse and you or your spouse was to pass away, you would automatically inherit under the laws of succession in the UK. You would automatically inherit that. That's exempt from inheritance tax. The slight and the reason why I say in most cases and not all cases is because when you are a non-domicile, if you are, say, a UK domicile, which is unfortunately another can of worms, which I'm, maybe if you have any questions in relation to domicile, we can hop on a call separately. But if you're a non-UK domicile and a UK domicile, if you leave all of your assets as a UK domicile to a non-UK domicile spouse, only £325,000 would be exempt, and the rest would have to pay inheritance tax on, unless you do a special election to treat your spouse as a UK domicile. But if you do have any questions for that, I urge you to get on a phone call, because it can be, unfortunately, when you're talking about inheritance tax, it's hard to give generic advice especially considering how complex families can become. And obviously in today's world, you can't necessarily trust what you read online. So yes, between spouses in most cases is exempt, but not all cases.
Okay. Brilliant. Great answer.
If I can jump on,
Henry. Hopefully that answers your question, Amy. And one for Chris here. How does financial planning charges work?
Yeah, just before I answer that one, just back to Amy's. I highly suspect you're probably, or at least the only thing I'm thinking, the reason you're doing that is for, say, income tax planning. There's probably some other options out there. Happy to go through it, or Henry more than likely will. 20 minutes, go through those and say, actually, what is the right thing you should be doing? Because gifting property to a spouse, it might be helpful, but actually, there might be better ones out there. So yeah, drop Henry an email. His email's there. He'll be easily be able to help you through that one. But yeah, back to Mo. Financial planning charges are super simple. You don't pay me unless it's a good idea. Very, very simple. We meet up, we have a conversation, we talk through your entire circumstances. I do a holistic advice. I provide you recommendation reports. We go through it together, and only if you agree it's a good idea and that you're happy for us to implement it, will you pay us a fee. And near enough, it's just a percentage based on the value of the funds that we're providing advice on. As an advisor firm, we're pretty good charges compared to the rest of advisors out there. But I would say the standard of advice you get here is fantastic compared to others, particularly because links with the tax team, links with our accountancy team, et cetera. The standard is so much higher here. So yeah, highly recommend it. That at least you have the 20-minute consultation with me. If it sounds like something you want to talk through, I can tell you if it's helpful in 20 minutes. You can then decide whether you go, into the more in-depth stuff. So please, my email's there. Drop me one. We'll have a chat, Mo.
Okay, thanks, Chris. And then we've got one final question before we head off, if there's no other questions. Are you able to advise on international tax? So probably around 30% of our client base are based overseas. So we deal with a lot of non-UK residents who have invested in UK assets. So particularly on UK tax, non-UK residency and domiciliary issues. What we've been able to do at Fusion over the past few years is, because a lot of our clients are overseas and they do have other interests in other jurisdictions, we've created Fusion International. And Fusion International is a group of independent tax practitioners who are qualified in all major countries around the world, so that we're able to collaborate and provide multi-jurisdictional tax advice. So yes, we should be able to help and introduce you to some of our partners in the jurisdiction which you require tax advice in. All righty, so I'd like to obviously thank everyone who joined today and is viewing this on demand. I'd like to thank Henry and Chris for their time and words of wisdom. Please feel free to engage with us and take advantage of the 360 consultation. We'll be working hard over the Christmas period anyway because of the tax return deadlines and end of year stuff. We've got a bumper program planned for 2023. We're going to be doing private client and corporate webinars every month. So we're going to be increasing the amount of webinars we do for you. There'll be events coming up, charity events coming up. We'll be launching a podcast as well in 2023. So really exciting plans, enabling us to provide you with education, things you should think about in your life and your businesses. But for now, I'd like to wish you all a Merry Christmas, a good festive period, and if we don't see you beforehand, a very Happy New Year.
Take care, everyone. Bye-bye.
Take care.